Welcome to the case study learning series in marketing management by Skilled MBA. In this session, we explore a high stakes case of contrarian strategy, Jose de Mello Group's exit from Brisa Highways during Portugal's economic crisis. When most investors fled the market, JMG made bold strategic moves, betting on intrinsic valuation over market panic. This case helps us understand how to value companies in turbulent times and how deep insight can guide high impact decisions, even when they go against the crowd. Let's begin with an overview of today's presentation. Theoretical framework. We'll start by exploring the evolution of discounted cash flow methodologies and how they are applied in modern financial analysis. Market context. Next, we'll examine Portugal's economic crisis and its influence on overall market valuations. Case analysis. We'll then dive into JMG's strategic assessment and the decision making process they followed during uncertain times. Implications and conclusions. Finally, we'll conclude with key insights and actionable strategies for navigating market downturns in a corporate setting. To understand this case, we begin with the foundation: discounted cash flow, DCF methodology. In 1340, early interest tables introduced time value concepts. By the 1930s, theorists like Keynes and Boulding refined the internal rate of return, and Samuelson compared IRR and NPV. In 1951, Joel Dean formalized DCF for capital budgeting. Today, DCF remains vital, with free cash flow to firm (FCFF) and free cash flow to equity (FCFE) as dominant models. This theory frames the lens through which JMG viewed its investment in Brisa. In this case, JMG primarily used the FCFE model, which values the cash available to equity holders. Definition: net income plus depreciation minus capital expenditures, adjusted for working capital and net debt issuance. Application: appropriate when valuing equity stakes, as it excludes debt servicing. Considerations: requires careful reinvestment analysis and avoids double counting excess cash. This model gave JMG a focused lens for evaluating Brisa's equity value during crisis. Let's compare. FCFE, cash to shareholders after debt, discounted at cost of equity, values equity directly. FCFF, cash to all providers, discounted at WACC, values the entire firm. JMG chose FCFE because they were evaluating their shareholder value, not the company as a whole. In practice, FCFF, FCFE plus interest, paid to lenders after tax. Choosing the right model is critical in pricing risk correctly. JMG's decision happened during Portugal's deep economic crisis. Banking sector, liquidity dried up, non-performing loans surged. Sovereign debt, government debt reached unsustainable levels, triggering bailouts. Equity market, sharp declines created panic. Infrastructure stocks weren't spared. Brisa impact, toll revenues and traffic volumes dropped sharply, compounding risk. The environment created extreme valuation distortions, but also opportunities for those who looked deeper. JMG, a major shareholder in Brisa, was under pressure. Stock price collapse. Brisa's shares fell far below their intrinsic valuation. Loan collateral risk. Deutsche Bank feared margin calls on pledged Brisa shares. Governance threats. Partner groups began maneuvering to seize control. JMG needed to act to protect its influence and realize value that the market was ignoring. Brisa wasn't a speculative holding, it was a core, long-term infrastructure asset, largest toll operator in Portugal with a comprehensive highway network. Long-term concessions ensured predictable, recurring cash flows. Traffic declines were temporary, with potential for post-crisis rebound. Its strategic value within JMG's infrastructure portfolio made this an asset worth defending. At the height of the crisis, market value plummeted, driven by investor panic and liquidity exits. JMG's valuation models, using FCFE, showed a major gap between traded prices and long-term value. This divergence became the central insight. The market was mispricing Brisa, and JMG had to decide whether to seize the moment or stay on the sidelines. JMG's strategy aimed to retain control, prevent hostile takeovers of a national asset, capture undervaluation, buy shares below fair value, reduce risk exposure, mitigate margin call threats, outmaneuver rivals, block other shareholders from gaining an advantage. All of this required swift capital mobilization and a deep conviction in their valuation model. JMG's approach was analytical and grounded, traffic projections based on economic cycles, historical data, and elasticity models, revenue forecasting, factored in toll adjustments and concession timelines, cost structure review, focused on efficiency gains and fixed cost leverage, discounting model, used the FCFE method with a country specific risk premium and a cautiously estimated terminal value. This disciplined valuation gave JMG the confidence to act while others hesitated. JMG's contrarian decision paid off due to four advantages: short term inefficiency, crisis distorted market prices, information edge, deep operational insight into Brisa's resilience. Long term thinking, the market was panic driven. JMG focused on fundamentals. Strategic conviction, the courage to act when others fled was the differentiator. Their ability to see past volatility was grounded in data, not emotion. JMG evaluated four options: option pros cons, maintain status quo, no added capital risk of takeover, lost influence, increase ownership, exploit low prices, retain control, capital outlay during crisis, full privatization, total control, highest investment, regulatory hurdles, partial divestment raise, funds quickly reduced strategic say. JMG chose a hybrid of increasing ownership and partnership restructuring, preserving both influence and upside. Execution involved four steps: value recognition, they formally identified the price gap and opportunity; partner restructuring, realigned ownership interests to limit conflict; capital reallocation, secured necessary funding despite the liquidity crisis; execution strategy, launched a countercyclical acquisition plan, acquiring additional equity and eventually leading to privatization. Their long term bet was validated as Brisa's performance recovered post crisis. Key insights from this case: market prices can lie, especially during crises. Valuation models matter more than sentiment. Strategic flexibility is survival. Firms must adapt quickly in unpredictable environments. Information asymmetry is power. Internal knowledge gives a decisive edge. Decisiveness during chaos is often rewarded if based on disciplined analysis. This case proves that great strategy is a blend of insight, courage, and timing. In summary, Jose de Mello Group's strategic exit from Brisa during Portugal's economic downturn is a masterclass in valuation driven, contrarian strategy. While others reacted emotionally, JMG focused on fundamentals, preserving long term control and capturing value others couldn't see. Thank you for joining this session of the Case Study Learning Series in Marketing Management by Skilled MBA. We hope it empowers your understanding of how to lead through financial uncertainty with vision and precision.